Welcome to TrendWatch. In Tutorial 105, we discussed the factors that influence options prices. We learned that the price of the underlying asset has the most significant impact on the price of its options. In this tutorial, we will discuss how options are categorized based on their underlying asset prices. This classification is one of the most important concepts in options trading. Based on the price of the underlying asset, options can be classified into three categories according to their strike prices: in the money, ITM, at the money, ATM, and out of the money, OTM. Each category has distinct characteristics and associated trading strategies. An in-the-money option refers to an option that allows the buyer to make a profit when exercised. Here are some examples to illustrate this concept. A call option allows the buyer to purchase a stock at a predetermined price, known as the strike price. If the strike price is lower than the current stock price, the buyer can exercise this option, buying the stock at a lower price and profiting from the difference. This situation, where the strike price is less than the price of the underlying asset, is referred to as an in-the-money call option. This screenshot displays a typical options chain for any underlying asset. To clarify, call options are listed on the left side of the table, while put options are on the right. A horizontal divider marks the current stock price. This is the options chain for NVIDIA expiring on 25th April. The current price is $110.93. For call option strike price of $106, the buyers can exercise their right to buy the stock at $106. They can keep the stock or sell it immediately to get a profit of $4.93. This call option is known as in-the-money call. When we apply the same principle to put options, we find that they function oppositely to call options. An in-the-money put option has a strike price that is higher than the current stock price. This allows buyers to sell the stock at a higher price, enabling them to profit from the transaction. Using the same options chain for NVIDIA expiring on 25th April. The current price is still $110.93. For put option strike price of $114, the buyers can exercise their right to sell the stock at $114. If they do not own the stock yet, they can immediately buy the stock at $110.93 to make a profit of $3.07. This put option is known as in-the-money put. Defining out-of-the-money options is now straightforward. These options are the opposite of in-the-money options. Buyers of out-of-the-money options will not profit at expiration. A call option is considered out of the money when the strike price is higher than the current stock price. In this case, buyers are unlikely to purchase the stock at a price higher than its market value. Using the same options chain for NVIDIA expiring on 25th April. The call option strike price of $114 is an out-of-the-money call. Exercising the right to buy at $114 for a stock that is worth $110.93 doesn't make sense. On the other hand, a put option is the opposite of a call option. When the strike price is lower than the stock price, the put option is referred to as an out-of-the-money put. In this situation, buyers are unlikely to exercise their right to sell the stock at a price lower than the current market price. Using the same options chain for NVIDIA expiring on 25th April. The put option strike price of $107 is an out-of-the-money put. Exercising the right to sell at $107 for a stock that is worth $110.93 doesn't make sense. An at-the-money option, whether a call or a put, occurs when the strike price is equal to the stock price. Exercising this option does not result in a profit or loss. However, as shown in the NVIDIA options chain example, absolute at-the-money options rarely happens in real life. The market makers will not make an option strike price that is exactly $110.93. Option strike prices that are very close to the stock price will therefore be defined as at-the-money options. In this example, option strike price of $110 and $111 are considered as at-the-money options. To allow investors to have an easy view, trading platforms usually highlight in-the-money and out-of-the-money options with different colors. In this example, areas highlighted in light blue are in-the-money options, while out-of-the-money options are in white. One can easily tell from this options chain that the current stock price is between 110 and 111, just by looking at the colors. You may find these concepts and characteristics confusing at first, which is completely normal. Don't worry, you will gain clarity after completing a few trades. The more you practice, the more comfortable you will become. The concepts of in-the-money, at-the-money, and out-of-the-money options are crucial in options trading. Various strategies are employed based on these classifications. Some strategies are specifically designed for out-of-the-money options, while others are tailored for at-the-money options, and so on. We will build your foundational knowledge step by step before exploring more advanced applications of these strategies. Thank you for watching.